For the second session, before we begin the second session, gentle reminder on scanning the QR code display on the screen right now to download the presentation and also submit the question you may have in English. Okay. Now I would like to welcome Ms. Sanya Joseph, Head of APAC ESG Client Engagement, S&P Global Sustainability One on the stage to share on the topic of Key Sustainability Focus 2024. Please welcome.
Sawadika, thank you so much for your time and thank you so much for coming back. I'm always half afraid that people might just choose to not come back. But again, thank you so much for your time today and thank you so much for your attention. For the next 45 to 50 minutes, we're going to talk about two concepts which you will either have heard of or you would be hearing. Those are sustainable finance and biodiversity or nature risk or TNFD. Can I see a show of hands in the room from people who have heard of sustainable finance? Anybody who has heard about the term sustainable finance? Okay, a few here, no one here, a few there. Okay, that's good. Which is great because the whole idea of today is to generate awareness around topics that may not be commonplace today, but may be very, very important or relevant for us in the next 12 to 18 months. Right, so we'll start off with sustainable finance, and the agenda for the next 20 or so minutes would be to look at what is sustainable finance, who are the players in the sustainable finance field, how is sustainable finance even put into implementation, what is the instruments of sustainable finance, like what is a green bond, right? We can take Q&A in the end, or if there is a burning question or some clarification that's needed on a slide, feel free to raise your hand and we can have an interactive Q&A as well, right? So what we have on the screen here is the key players in the concept of sustainable finance. But before we start talking about the key players, let's understand what is sustainable finance, right? Now, you know banks. Now, everybody knows financial institutions, which is banks, asset owners, fund managers. Now, banks are always the source of capital. Who wants the capital? It's the corporates, right? So corporates would always take the capital from the bank, or they will take the capital from the asset managers, and they will use that in their processes and production. Now, what is sustainable finance? Now, where is the money going to be channeled? That is the idea of sustainable finance. Sustainable finance looks to make sure that the money flows into initiatives that is going to be green, that is going to help with avoiding climate change, that's going to create a positive impact on society. So money needs to flow towards those initiatives and those corporates that are going to promote the concept of sustainability. That is the idea of sustainable finance. Now, if the banks is the provider of capital and the corporates are the consumers of that capital, then how can a bank decide who they should loan a green bond to or who should they loan a sustainable finance instrument to? That is being decided by the regulator. Now, what does a regulator do? A regulator comes up with disclosure frameworks for its corporates that you have to talk about your sustainability initiatives, you have to talk about your emissions, you have to talk about how you're dealing with your stakeholders, like your employees, your society, the community, etc. They will come up with taxonomies to decide what activity is termed green, what activity is termed red, and what activity is termed amber, right? So the regulators could be your exchanges, could be your central banks, could be the securities commissions. So these are the bodies that will decide that what are the guidelines that should be used to implement the channeling of money towards sustainable initiatives. Right, so which is why you will see that a lot of the regulatory initiatives would be directed towards corporates, which would be disclosures, and a lot of the regulatory guidelines would also be directed towards financial institutions. The last player, not the last player, but one of the key players in the sustainable finance landscape is a consultant or data providers, because in order to make any decisions, you would need an external help in understanding what is the framework I need to use for disclosing emissions. How do I account for how much oil am I using and how is that going to convert into emissions? Where do I get the data for what are the other companies in my same industry doing, right? So that is why you have the data vendors and consultants. That works with financial institutions. They work with corporates in helping them drive their sustainability initiatives, right? So these are essentially the 4 key players of sustainable finance. Now, what do we actually mean when we say instruments of sustainable finance? Has anybody heard of ESG funds? Show of hands of anyone who has heard of ESG funds. Okay. This section is comparatively lacking compared to the right and the left. So we need to see more hands from the center here. How many of us have heard of green bonds? Okay, that was an even spread. So these are essentially the instruments of sustainable finance. You would either have ESG funds, which could be equities or fixed income mutual funds that would have some sort of like sustainability as its theme, or it could be the loans given out by a bank to build a solar farm or to kind of like retrofit a building, which is going to help with energy efficiency. Now that's called as green loans. So anything that a bank gives out is going to be green bond or green loans. Anything that an asset manager creates, which is aimed towards sustainable finance, would be an ESG fund. So let's start by looking at ESG funds, and we'll start by looking at how did the ESG funds perform in the last 1 or 2 years. So how are people putting in money into ESG funds? So if I were to ask people in this room, if you get, let's say, $100 and you want to put it in a mutual fund, how many of us would put the money in a mutual fund, which is a traditional mutual fund which doesn't have a sustainability focus? Or would you rather put that $100 in an ESG fund which will have a sustainability focus? How many of us would put the money in a traditional fund? Show of hands. And I totally understand that a traditional fund would be a fund which looks at companies that are profitable. They look at how a company is going to generate its money, its business models, its growth models, and they will choose those profitable, highly valued companies, and they'll put the money in that because they know I'm going to get high returns. How is an ESG fund manager going to decide which companies to choose? They would essentially look at companies that are promoting sustainability initiatives, or maybe they have high disclosures, right? Now, as a traditional investor, I may think that an ESG fund may be better. I may think that a traditional fund may be better. Now, so there are 2 kinds of funds. A conventional fund, there is an ESG fund. If you look at the graph on the top, it essentially looks at how the ESG fund landscape has grown over the last couple of years. So you can see that obviously Europe is driving it. There is a lot of ESG fund flows that's happening in asset managers domiciled in Europe. You'll also see that APAC, which is the yellow box, has been consistent. You will see that 2022 Q4 is when we had a really high inflow, and 2023 Q1 to Q4 has been pretty flat, in the sense it has had relatively stable fund inflows. Now, when we look at the graph on the bottom, what do we see? How many companies, how many investors are putting money into a conventional fund as opposed to ESG fund? So the green bars represents the fund flows, and you will notice that in Q4, ESG funds actually had more people put money into them as compared to conventional funds. Likewise, when it comes to investing, there are passive investment strategies that actually outperformed the actively managed ESG strategies, right? So the idea of this slide is to indicate that there is a growing interest and there's a growing channeling of capital towards ESG funds. We saw that Europe was the one who was driving ESG funds, but does that mean that APAC is lacking behind? It doesn't necessarily mean that APAC is lacking behind. If you see this graph over here, this is the countries where you have had ESG funds. This is Asia ex-Japan, right? So you can see that obviously in the last couple of years, most of the ESG investing or the ESG funds has been driven by most of the ESG funds here have been driven by China, and you'll also see that Taiwan, interesting. So you'll see that Thailand, where is Thailand? Thailand is also there. Assets in Thailand, domiciled ESG funds increased sharply in the fourth quarter of 2023. So there's almost $236 million that are going into ESG domiciled Thai funds. So essentially, Thailand is a nice growing market for ESG investing. So people who chose to invest in conventional funds would also potentially be moving towards an ESG fund in some time. Now, it is great when we have sustainability initiatives. It's great when we say that I want to put money or invest in companies that are green, but there'll always be challenges to it. One of the most commonly cited examples of a challenge is greenwashing. A lot of companies, they say that we are green, or they may set targets, but they may not necessarily deliver on those targets, right? So greenwashing is a real challenge. The other challenges towards ESG investing is going to be your macroeconomic conditions, your inflations, your general economic indicators that may also result in the investors choosing a safer option as compared to a newer option. However, generally speaking, we would still expect Asia to kind of like outperform. Now, why is Thailand expected to be a growing market? Now, one of the kudos that I would like to give is for the scheme that was launched by Thailand, where there are tax breaks that is eligible for ESG funds. So as an investor, you're exempted from almost 30%, you're exempted from taxes for almost 30% of their income if you were to put it into ESG funds, right? So there is a strong push by regulators in Thailand for channeling the money towards greener initiatives, because this will also help Thailand reach its sustainable development goals. Okay, so we know ESG funds are expected to receive money, and asset managers will be creating ESG funds. What is ESG funds? It's essentially a list of companies that they will be choosing to invest in. Now, how does an asset manager choose which companies they will be putting in their fund? Now, if we look at what Europe has outlined as the investing criteria for a lot of their asset managers, they say that you have to invest in companies which essentially disclose on energy and renewable energy, use of energy and renewable energy. They have to disclose on how much waste is being produced and the impact of greenhouse gases. They have to have a positive impact on biodiversity. You have to think about circular economy. You have to think whether that company is tackling inequality. Is it going to improve the social impact it's making on its communities, right? So as an asset manager, if I have to select which companies I will put in my fund, in Europe, these are expected to be the guiding principles that an asset manager will choose. Everything can be boiled down to essentially these three principles. First, you need to have good governance. If your corporate doesn't have a good governance system, you don't have a proper board, you do not have proper risk management policies, you do not have proper reporting practices, then you are essentially screened out. No asset manager would prefer to invest in a company with shady corporate practices. Secondly, do no significant harm, which means that even if you're not positively contributing to a specific criteria, you should not at least be making a negative impact on that criteria. So let's think about biodiversity. Even if you're not going and planting trees and creating forests, but are we clearing forest. Am I as a corporate doing deforestation, right? So you should not have a negative impact on biodiversity. The amount of waste that I'm generating, how am I taking care of that waste? Am I just dumping it into the waters? Am I polluting the marine ecosystems, resulting in the species to go dead, right? So the idea is that you need to look for companies that at least do no significant harm. Last, if it is an ESG fund, then you need to have companies that make a positive impact on at least one ESG-related criteria. It could be a social criteria around gender, it could be a social criteria around education, it could be environmental criteria around greenhouse gases, but you need to have some positive impact that you're making on at least one ESG criteria for you to be considered relevant for a ESG fund. So this is generally the logic that any asset manager will use when they're looking at any particular company. So first, does the company meet a good governance criteria? If it does meet it, it will check for the next one. Is the company doing any significant harm to the economy, to the circular economy, to the environment, to biodiversity? If it is, how do I check for significant harm? First of all, is the company involved in any strong media controversy? Is there any lawsuit on this company? Was there any accounting fraud that was announced by a whistleblower? Second, is the company involved in controversial sectors? Now, what are controversial sectors? Alcohol, tobacco, defense, right? So any companies that is generating revenue from any of these controversial sectors would more often than not get removed from an ESG fund. And then if we decide that the company doesn't do any significant harm on any of these previously described ESG criteria, then there is a final check that is done to see, is there a positive contribution on at least one criteria? If yes, then that company is now eligible to be a part of the ESG fund, right? Now, you can understand that as an asset manager, if I wanted to really execute that previous workflow, sorry, I'm trying to go back. Okay, if I were an asset manager and I have 300 Thai companies, and I wanted to do this sort of like an exercise for all the 300 companies, how much data I would need, right? So there is a big requirement of data by the asset managers to help them truly understand and assess a company. And that is where the CSA comes in. Where do the asset managers get the information that they would need to assess a company? That is based on the corporate sustainability assessment that you're filling. A lot of the big asset managers, they actually take the ESG scores from S&P Global. So big names like BlackRock, a couple of others that I can't name. So you have really big asset managers which have an AUM of almost $38.4 trillion are using the ESG scores to understand the sustainability performance of a particular company. Radhika in her session had talked about the indices that is being created by DJI, right? So there is Dow Jones Sustainability Index, there is DJSI World, DJSI Emerging Countries, there are ESG indices. So when you look at the amount of ETFs that are tracking these ESG indices, almost $29.3 billion goes into these ESG funds that S&P creates. How is S&P creating these ESG funds? Again, a big portion of that is driven by the S&P Global ESG scores. What is S&P Global ESG scores? It's essentially the output of the CSA questionnaire. So once the corporates, like yourself, fill in the questionnaire, you will be given a CSA score. I mean, like, obviously, there will be a media and stakeholder controversy scoring, and then finally, you will get a CSA score. Now, S&P will take that CSA score and it will do some modeling on that score for companies that are not participating in the CSA, and you will essentially have the S&P Global ESG scores. Now, it's these scores that are being used by asset managers to decide which companies are going to be in a ESG fund and which companies are going to be out of a ESG fund. Let me give you an example. One of the popular S&P funds is an ESG index called as S&P Asia Pacific Developed Large Mid-Cap ESG Index. Now, what they essentially look to do is they will start with the entire large cap of Asia Pacific companies, and they will now remove certain companies to now create an ESG version of this fund. What is this fund? This fund is targeted, or this fund is supposed to be a collection of the largest companies in APAC. Now, the first thing that it does is it looks at the parent index, and it will exclude any company that generates revenue from tobacco, that generates revenue from controversial weapon. It will exclude any company which has a low UNGC score, right? The next thing it will do is for every industry group, it will look at the bottom 25 percentile companies from an ESG scores perspective. So those companies that are scoring the lowest in any industry group gets filtered out. Again, we are not saying that the company that scores below 25. We are looking at percentile. The lowest of the 25, the lowest 25 percentile of the companies in an industry will get filtered out. This approach is called as negative screening. I don't know if you're familiar with it, but yeah, right? So now we have removed all the companies that are not going to be eligible for an ESG fund. How do we select the companies from the remaining? From the remaining set, we'll only look at the top 75 percentile of the companies in each industry. And those are now going to be the companies that are going to be part of this index. Right? So we will not be removing any sector completely. We will have exposure to all the sectors. We'll only be looking at the best-in-class companies in each sub-industry. Right? I'm sure everybody has heard of S&P 500. Anybody who has not heard of S&P 500? That was a trick question. Right, so S&P 500 is the collection of the largest 500 US companies, right? Now, we created an ESG version of that S&P 500 index. It's called as the S&P 500 ESG index. Now, what we did is apply the same process there, and now the S&P 500 ESG index only has 340 constituents. So what does that mean? There are almost 160 companies from the S&P 500 that we excluded. Why? Because they were either deriving revenue from tobacco or controversial weapons. Let me give you an example. How many of us have heard of this company called as Philip Morris? It's a tobacco company, right? So 100% of its revenue comes from tobacco. The first company to get out of S&P 500. There's another company called as Wynn Resorts. Again, it's a US domiciled country, but 100% of its revenue comes from operating casinos in Macau. That also gets kicked out, right? So this is a general process of how we look at a particular index, and we create an ESG version of it. And then a lot of asset managers will now be creating ETFs using these index. Okay, so this was a brief overview of ESG funds. We'll start talking about green bonds. But actually, is there anybody who can tell me the difference between a green bond and a social bond? Anybody has heard of social bonds? Okay, somebody has heard of social bonds. Okay, so somebody in all of these sections have heard of social bonds. Now, as a corporate, we all know that as a corporate, we will issue bonds when we need money, right? Now, the traditional kind of bonds are called as your fixed income bonds, where a company will say, okay, I need some money, and I will issue this bond, and investors will buy that bond, and you will get the money. There are different kinds of sustainability-linked bond issuances that a corporate can do. First is you can issue a green bond. What is a green bond? Any bond which is, the idea of which is to collect money that goes towards a green project. So if you want to retrofit your buildings to now have a better energy efficient electric utilities, or if you want to create a new solar farms, or if you want to kind of like improve the infrastructure and put up like green roofs in your buildings or solar panels in your buildings, all of those projects that can have a positive impact on the environment can be categorized as a green bond, right? You can also issue a social bond if you want to kind of like promote social objectives. So let's say, for example, if you want to do some sort of like gender equality programs, if you want to kind of like do some sort of like anything which does anything that has a positive impact on society. So could be gender equality, could be focus on education, could be focus on food distributions, could be focus on water and life conservations. Again, there is a concept called as SDG. So the idea of an SDG is to create 17 goals that will result in the world being a much better place, right? So when it comes to society goals, there would be goals around no poverty, there is goals around zero hunger, and there's goals around, I can't see what this 3 is, but good health and well-being, okay. So any initiative that a corporate wants to do that can promote any of these SDGs will be applicable for a social bond. There is a sustainability bond wherein it is a bond that is used to finance or refinance a combination of green and social. And then you have a last kind of like bond called as sustainability linked bonds, where the issuer will achieve a predefined sustainability objective. So let's say, for example, biodiversity. You're filling in the CSA questionnaire, you see a section on biodiversity, right? You're like, oh, what is biodiversity? I don't do anything positive for biodiversity. Then as a company, you decide, okay, I want to now do something positive for biodiversity. I want to plant trees, I want to get some sort of like conservation efforts going, I want to kind of like conserve a particular forest. You can now issue a sustainability linked bond towards that particular initiative, saying that, okay, I would now like to have a positive impact, and these are the key KPIs. Like, for example, by the end of 2 years, I will bring 25,000 hectares of land under conservation, right? So you can come up with KPIs which are linked to any sustainability related initiative, which can be funded using a sustainability linked bond. So as a corporate, you have access to any of these 4 instruments to drive financing towards sustainability related initiatives. But yes, obviously with great power comes great responsibility, which means that when you do issue any of these bonds, there is going to be additional disclosures required by a corporate. Every year you would need to disclose how have you used the proceeds, and you would need some sort of like an external auditor to verify that the proceeds have really been used for the causes that you had taken the loan against. Right. Now, we saw the trend of ESG fund inflows. Let's look at some of the trends for bond issuances. You would notice that over the last 10 years, there has been an increasing number of green bonds that has been issued, right? 2021 was the year which saw the highest issuance in green bonds, but that doesn't mean that it has fizzled out. Even 2022, 2023 has been a good year for green bond issuances. If you look at the top 10 countries that have issued green bonds, it is very heartening to see that Thailand is actually number 6. Oh, this is not just green bonds. This is green, social, and sustainability linked bonds. So you will see that Thailand is one of these markets in Asia which has issued a really high number of green bonds, GSS bonds. Okay, so what is driving the cumulative volume of these green, social, and sustainability-linked bonds? It's usually going to be government-backed entities, financial corporates, and non-financial corporates, and development banks. Okay. What is this? Okay, so what are the challenges when it comes to green bonds issuances? It's similar to the challenges that we talked about from an ESG fund perspective. There is a very uncertain future in the US where there are states and government policies that are currently in support of sustainability initiatives, but it is also quite possible that this environment may change depending on the government that's going to be in effect in the US. There are a lot of geopolitical uncertainties as well, which may take the focus away from climate. There are also macroeconomic uncertainties around inflation and high interest rates that may also impact the issuances. So there are certain challenges, but we expect there to be almost 1 trillion of new issuances of GSS plus sustainability-linked bonds in 2024. Okay. Okay, so I hope this gives you a good overview of what is sustainable finance and what the corporates can do to leverage on this concept of sustainable finance. I'm going to take a break and see if there's any Q&A before I move into my next section. No questions? Okay, good. We can save all the fun questions till the end. That's also okay. Okay, so let's talk about biodiversity. How many of us have actually heard of TNFD? Show of hands, TNFD. Anybody who can tell me the full form of TNFD? There's a special gift for anyone who can tell me the full form of TNFD. Okay, I'll keep this special gift myself. So TNFD stands for Task Force on Nature and Development. Nature and Financial Disclosures. Right, so why should we talk about nature? Why is nature even important? We have such pressing matters like climate change. So why are we even talking about climate? Why are we talking about nature? Now, in this review commissioned by the UK government in 2021, this review found that over the last 50 decades, there has been a tremendous increase in the production capital. The goods that we have produced has gone up tremendously. Human capital has also improved, but what has actually decreased is natural capital. For every goods that we have produced, for all the economic growth that we have had as a world, the price was paid by nature. This is a report produced by the World Economic Forum, which lists out the top 10 risks that the world is going to face in the next 10 years. The first and the biggest risk that the world is going to face is a failure to mitigate climate change. What's the fourth largest risk that we are going to face as a world? Biodiversity loss and ecosystem collapse. So the World Economic Forum lists the loss of nature as the fourth biggest risk that we are going to face in 10 years' time if we don't do anything about it today. Nature doesn't need to be separate from environment, or it doesn't need to be separate from the climate initiatives that we are running. When we talk about emission reductions, one of the biggest things that we think about is carbon storage and capture. But guess which is the biggest source of carbon storage? Nature itself. If you look at the soil, you would notice that the soil in the wetlands actually stores 643 tons of carbon as compared to the forest. If you look at temperate grasslands or the boreal forest, they are able to store so much more carbon than the trees themselves. When you preserve a forest, you help decarbonize the world. Now, everything is always more relevant and understandable once we quantify it. right? So now every industry would have certain dependence on raw material that we get from nature, right? So if you're, let's say, Nestle, you would need agricultural products. If you're, let's say, a pharma company, you will need a certain other set of agricultural products or animal products. If you are, let's say, a textile manufacturer, again, you will have dependence. If you're a metal and mining company, you will have dependence on nature, right? Every company, every corporate in some shape or form will take something from nature for its production. 85% of the world's largest companies actually have either a moderate or a high dependency risk on nature. 46% of the world's largest companies have at least one asset located in a key biodiversity area. What does this mean? So there are areas that are protected by either cultural or legal laws. There are areas that are given importance because of the species that reside in those areas. They're called as protected areas, or they're called as key biodiversity areas. 46% of the corporates in the world have at least one asset which is located in a KBA. There is a big dependence again on nature from a land perspective. So in 2021, 22 million hectares of land was used by corporates to directly generate close to $30 trillion in revenue. So now that we have all of these insights that yes, there is a dependence on nature, yes, nature is critical, loss of nature is going to be a big risk for us. So how did all of this understanding kind of like assimilate or come together? So in 2022 December, there was a biodiversity-focused COP that happened in Canada, where it was agreed to now come up with a framework that would look at a biodiversity conservation. What are the targets of that biodiversity framework? So they have set out 2030 targets, which says that in the next couple of years, we will bring at least 30% more of the world's land and coastal areas and oceans under conservation. It said that we would also target to restore 30% of terrestrial, marine, and ecosystems. You have to halve the global food waste, and money needs to be raised from developed countries to support the developing countries in this initiative. And we need to phase out reforms from initiatives that are negative to the biodiversity. Almost $500 billion is expected to be removed from funding or subsidies for actions that may have a negative biodiversity impact. Now, why is this important? Let's say I'm corporate A, and I'm working or I'm operating in an area which is adjacent to a protected area. Now, it is going to be important for me because as more and more land is going to be brought under conservation, it's quite possible that the land that I intend to operate on or the land that I'm currently operating on may be brought under conservation. So this may directly impact your operations. Once the Global Biodiversity Framework was released, that's around the same time when TNFD came into effect and said that just as we are focusing on climate, we need to focus on nature. We are all doing climate change related disclosures. We're all talking about greenhouse gases. We're all setting up board strategies. We're all setting up commitments. So what TNFD said is, we're going to follow the similar principles of TCFD. We will not reinvent the wheel. And we would now expect the corporates to follow what's called as a LEAP approach. What is that? You first will have to start by identifying where your assets are located. You would also then need to understand what is the impact of your assets on the areas that you're operating in. What is the dependency of these assets or your operations on the environmental or the nature-related raw materials? That's your evaluate. You evaluate your dependency and your impacts. What's the next step that a corporate is expected to do? Assess. You have to assess how material is that risk to your revenue. So if you're currently sourcing a raw material from the nature, 2 years down the line, if this particular raw material becomes extinct, or maybe that species no longer is being produced, would you still be able to continue generating that revenue? Do you have any other substitute raw material that we can use instead? Right? So how critical is the lack of that raw material in my production and revenue process? So every corporate would be expected to assess the material risks from lack of nature or from the dependence on nature. Last is to prepare. Prepare is, as in you have to come up with your strategy on how you would become nature positive, and you would need to start reporting just as you're doing TCFD disclosures. You would be expected to do TNFD disclosures as well. Now, we might think that it's not very important. Why do I need to care about TNFD? Nobody is asking me in Asia to do anything on nature. Why do I care? We care because most of the Asian economies are export-driven. Europe recently came up with a rule which said that it will not import anything from countries that are promoting deforestation. Which country did it affect the most? Malaysia. Big portion of Malaysia's export is palm oil. Big portion of palm oils are coming from land which were deforested, right? So when Europe or any other stakeholders comes up with these policies around being nature positive, it may directly or indirectly affect us. So the sooner we start thinking about the risks, the sooner we start becoming nature positive, the better it is. But as with everything, as with TCFD as well, nothing was achieved in one day. So we understand that sustainability, nature positivity, everything is a journey. So we can think of it as a step-by-step approach. Your first step would be in identifying or locating where your assets are. How many of your assets are actually located in a key biodiversity area? How many of them are actually having a negative impact on the species? So you start by identifying those. Your second step would be to now have a quantitative assessment of the impact and dependencies. Your third step would be, as I said, in identifying your risk mitigation strategies. And your fourth step would be in being a nature and biodiversity champion. What does that mean? The fourth step indicates that a corporate is always going to be a nature's champion, that any strategy that you decide, any business decisions that you take, you will always think of nature first to say, am I negatively impacting the nature? Am I resulting in any species going extinct? What is the impact of my operation on the environment that I'm operating in? Let me give you a few examples of what does this locate mean. When we looked at the global databases of mines, so what you're seeing over here, the green areas are your natural habitat. The shades of purple are your modified areas where the land has already become degraded. Now, what we are noticing is there are 40% of the mines that we looked at are currently in areas that are natural or potentially natural habitat. We need to move those mines away from natural habitats. But a lot of these mines could be older mines, but no. 60% of the mines that are actually located in these potentially biodiverse areas are in the exploration stages, which means that the understanding of biodiversity risk is not something that a lot of corporates are still taking into account. The loss of biodiversity is not an active thought in a lot of corporates' mind. When we think about climate change, lithium as a metal figures really top in the list of metals that will have a positive impact on climate change mitigation. Why? Because lithium is what is going to be used in your batteries and in your EV cars. So when we look at mines that are mining for metals or materials which are going to be key for energy transition, we notice that almost 29% of these mines are located in a key biodiversity area, which means that sometimes we can be climate positive. We are doing things for the right reason, but it can have a negative impact on biodiversity. Let's make sure that climate and nature coexist in our decision-making process. Same with renewable power as well. So When I look at renewable power in Spain, at least 12% of the renewable power plants in Europe are actually located in a KBA. So what can be done about it, right? Now, how do I, as a corporate, start thinking of quantifying my impact on nature? Now, for this, S&P Global has partnered with United Nations Environmental Protection Program to come up with a robust methodology which is in line with the TNFD framework. Our methodology essentially looks at two things. It looks at first quantifying the impact. The impact is based on how much land are you operating in, and also what is the significance of the land that you're operating in. If you're operating in a city versus operating in an Amazon rainforest, there is going to be a difference. Second is the dependency. Now, when we start thinking of dependency, what we do is we start by looking at, as an industry, what are the raw materials that you would be dependent on? That's your reliance block. The second block that we look at is how resilient is the land in continuing to generate that raw material that you need. So a measure of resilience. Risk mitigation is going to be a section where we think about the raw materials that you're using, are they going to be substitutable? Is it going to be something that can be, that will never be, that may end up getting endangered, right? So we essentially look at the reliance of your industry on certain ecosystem services, as well as majorly the resilience of that land in continuing to generate that function. So this is what I was talking about. Now, if a raw material that you're currently consuming, if that were to be disrupted, how significant is the loss of functionality in your production process? Is it a limited loss? Is it a moderate loss? Moderate loss in the sense that you may have another substitutes that you may use, or is it a severe loss? A severe loss would be something that prevents you from your production process continuing. Now, if your production process were to be impacted, how significant is the financial loss associated with that? Maybe that particular element that you were generating or producing was only 1% of your revenue. Maybe it doesn't have a very high financial loss. So if that production process gets disrupted, you may have limited financial loss, moderate financial loss, or severe financial loss. So what we do is we work with corporates in understanding where their assets are located, and we will be doing all of this thing that we just walked through, and we will be producing a PDF report which would essentially identify, first, what is the reputational regulatory risks your company is facing because your assets were located in a KBA or a KP. We'll also be quantifying the impact. So we would say that, yes, in the sample report, we will say that, okay, this company was operating in 408 hectares of land, but then it has maintained the land quite well, such that the impact is very low. We'll also be quantifying a dependence where out of 1, we will be giving a score. The closer you are to 1 means the higher dependence you have. And we are looking at 21 ecosystem services. And we'll also say that, okay, which of these ecosystem services does your company have a material dependency on? In addition to all of this, this report will also have the asset level analysis for the top 20 assets in your firm. And we'll also be giving you a peer benchmarking report against 3 of your peer firms. So that's it. So that finishes my presentation, but I'm happy to see if there's any questions on biodiversity, any questions around sustainable finance. Okay. Was this session even useful?
First of all, thank you very much, Ms. Sanya Joseph, for your valuable sharing. There are 3 questions from the audience. The first one, what is the difference between green bond and sustainability bond? And also, could you please share the successful use case?
Okay. So a green bond only looks at projects that are going to have a positive impact on the environment. A sustainability bond could be a green bond or it could be a social bond. So if you want to take out a loan towards, let's say, spreading education, that would be a social bond. If you wanted to take out a loan towards getting solar panels on your roof, that would be a green bond. So a sustainability bond is going to be a superset, and you'll have a green bond and you can have a social bond under it. So I hope that is clear. An example of a green, I just explained the example of a green bond and an example of a social bond. There is, however, a different kind of a bond called as a transition bond, which is becoming very popular. I don't know if there are many people in the room who have heard of transition bonds, but again, that's going to be extremely popular. It's something which is being very much used in Japan.
Okay. For the second question, there are two minor questions in one. Are TCFD and TNFD practices related to each other? Is it easier for a company who is working on TCFD to start implementing TNFD right after?
That's a great question. Yes, I would say TCFD and TNFD are very much similar in principle, because the idea behind both of them is that you need to have a strategy from the top. Both TCFD and TNFD are going to be top-down in the sense that your board needs to drive it, right? So if you're doing TCFD, which means that you would already have a board that focuses on nature, you would already have a strategy which thinks about how climate change is going to impact your business, and then you will have a sustainability team which is actually publishing your metrics and targets. Likewise, it would be very easy for you to now extend that from climate onto nature. So if you're doing TCFD, you can also do TNFD. But they are different in the sense that they are trying to evaluate two different things. So you can't take a TCFD report and substitute the word climate with nature and publish it. So the analysis is going to be different, but the principle is going to be the same. You need to have a board which starts thinking about, is nature important to me as an organization? You need to have a strategy team which thinks about what is the key raw materials that I'm getting which is dependent on nature, and 5 years down the line, if this site is now going to be protected or moved under conservation, how is that going to impact my business? You need to have a sustainability team that starts thinking about publishing a TNFD report, right? So if you have the TCFD, you're already 10%, 50% there. You just have to push the other 50%.
Okay. The third question. Thai companies usually use local biodiversity data source for risk assessment, not buying international data source like IBAT because of the cost. Is this local data source enough for TNFD and LEAP? Yeah.
I think data is data, and everybody needs to start somewhere. So I think having access to local databases is great. So if your operations are mostly focused in Thailand and you want to use the Thai database in terms of biodiversity-rich areas, perfectly fine. But these international databases, they are very useful when you have international operations and you want to understand the impact of those international operations. So TNFD never mentions that you need to stick with one method. It never says that you need to stick with one database. It always says that we understand this may not be easy, but you got to start somewhere. So it's perfectly fine to use a regional database as well.
Okay, thank you very much. There are two more questions, so this is very popular. The fourth question, what is the benefit in terms of interest rate or quantitative perspective of green bond over the typical bond?
Over the what bond?
Just a general bond.
Oh.
Yeah.
Okay, good question. Let's think about it. So if I were a corporate and I wanted money, I can raise a general fixed income bond and say, yes, this is my bond where I don't have to do any disclosures, or I can issue a green bond. Now, when you come up with sustainability-linked loans or when you talk about green bonds, there will always be better terms because you're financing a sustainable objective. So if you go to a bank, right? I know the question was green bond, but this is more or less similar. So let me give you an example of a bank. You go to a bank and you say, I need a loan. The bank is going to say, okay, fine, 10% interest rate, for example. But you go to a bank whose mandate is to do sustainability-linked loans, and you say that, yes, I want to take out a loan to put a solar panel on my roof so I can generate my own electricity. And because I'm generating my own solar electricity, my scope 2 is also going to go down, so this is going to improve my decarbonization initiatives. Bank's going to be like, okay, that's a great point. I am also mandated to fund finance towards these initiatives. I will give you this loan at 9%, provided you show me XYZ KPIs. Right? So any sort of like green or sustainability related initiatives will have better financing terms as compared to its counterparts.
Okay, one last question. Could you please give an example of the activity that does not meet positive contribution criteria under sustainable finance?
An activity that does not meet positive contribution. That's actually very simple. Now, if I were a power generating company and I said I generate 100% of my power, but everything is coming from coal, so that doesn't meet any positive contribution. I can be, on the flip side, I can be a company which generates 100% of its power from solar. So I will say, yes, I'm making a positive contribution here. But let's say 90% of your plants are actually located in a key biodiversity area. You're making a negative impact on biodiversity, right? So it is a tough act to balance that you need to be positive on some front, but you also need to make sure that you're not negatively impacting the others. So I hope that is a good example of how you can be positive and yet negative, or you can be so negative that nobody cares about the positive. Right? So you can generate 100% of your power from coal, but yet you can be the most employee-friendly company. You can have the bestest corporate governance in the world. You can do whatever. But if you're not going to be having a positive impact on climate, I think that's checkmate.
Thank you very much. And please give a round of applause for Ms. Sanya.
And a big round of applause to everyone in the room who sat for the entire 2 hours. So thank you so much for your time. Kapun Kha.
On behalf of the Stock Exchange of Thailand, I would like to thank you all the audience for joining the event today, and also thank you S&P Global for sharing your valuable opinion and also all the practice. After the event, SET will release a record video of today's event on SET website, and the link will be shared to your registered email. Thank you very much and hope to see you again. Have a good day. ขอบคุณค่ะ